right, that makes sense. Now let's get into those policy loan provisions. I understand I can borrow against the cash value in my policy.
Yes. The policy loan provision is a standard feature of whole life insurance. It lets you tap into that cash value you've accumulated.
Okay.
It works more like an advance against your death benefit than a traditional loan. The insurer can't demand immediate repayment or call the loan, and you can repay it whenever you want. There are typically no credit checks because your cash value acts as the collateral.
Mm.
However, if you have named an irrevocable beneficiary, you might need their consent before you can take out a loan.
So how does taking out a loan impact my policy?
Any outstanding loan balance, including interest at the time of your death, will reduce the amount your beneficiary receives.
Mm.
Likewise, if you surrender your policy, the loan balance is deducted from the cash surrender value you get.
So what about the interest on these loans? How does that work?
Well, interest is charged on the loan because the company was planning to use those funds for their investments. The specific interest rates vary depending on the insurer and your state's regulations. Some states have fixed rates, often capped around 8%. Others allow for variable rates tied to indexes like the Moody's Corporate Bond Index. Unpaid interest gets added to your loan balance, and if the total loan balance, the original amount plus interest, ever goes above your policy's cash value, the policy could lapse.
Wow. Are there any tax implications to taking out a policy loan?
Generally speaking, policy loans are tax-free while your life insurance policy is active. However, if the policy lapses or is surrendered, and the total loan amount, including interest, exceeds the premiums you've paid, and that excess is considered a gain and becomes taxable as ordinary income. Also, the interest you pay on a policy loan usually isn't tax deductible.